In today's episode, we're going to be talking about how to create passive income with mortgage notes. Yes, I said mortgage notes, not owning real estate rental property. So a lot of people believe that the only way to build residual income in real estate is by owning the property, managing the property, dealing with tenants and toilets. Unfortunately, with the higher cost of real estate, it's very difficult to find properties that cash flow positive. What I've been learning more and more about is just mortgage notes. And a lot of people don't realize that you can make passive income by owning a mortgage note. So in today's episode, we're going to talk about a business model where you buy a property for cash, you fix it up, you create a mortgage, you either sell the mortgage or you hold on to it for residual income. And a lot of times that residual income is a lot better than you would make if you were holding the rental property. So to help us with that, we got Nick Disney. He's a real estate investor out of San Antonio, Texas. Did you hear that round of applause? I think we have an audience.
I love it, man. I appreciate it. Thanks for having me today.
I'm excited about this episode. So good. So walk us through just on a high level overview,
Sure.
like what this business model looks like.
Right. So our business model is we want to create the most cash flow. And once we have a cash flow, we want the least amount of work for it. That's kind of how we started this direction. But we do what a lot of traditional real estate investors will do. We will buy a property. We're looking for a deal. We're looking for a property at a discount. We will rehab that property, right? So we're going to put some work in there. And so we've built in some equity in it. But when we sell it, instead of renting it, we're going to sell it. People are like, oh, well, you flipped this house. Well, we didn't, right? When we sold it, we're going to sell it to someone. They're going to give us a down payment and we're going to give them a mortgage. We're going to give them a long-term mortgage, 15, 20, most of them are 30-year mortgages because we want monthly payments that are coming in for the property, but we don't want to be the landlord. Now people talk a lot about seller financing and getting, sellers to sell you the house, where I think a lot of people could be hugely successful and accomplish a lot of their goals is by owning the mortgage where somebody is paying you each month without what comes along with being a landlord.
I love it. So let me ask you this, because most people, they buy a property at a discount,
Yep.
They renovate it, and then they sell it to a traditional buyer.
Mm-hmm.
Outside of the cash flow, outside of the cash flow, what's the benefit of selling on a note versus just cashing out on the profit and receiving a lump sum at that present moment?
Perfect. So you get that lump sum at the present moment, and there's nothing wrong with that. That is great. But if you take it in payments, anybody who's ever had a mortgage probably got an amortization table and they looked at it and they saw those payments and like, man, my first payment out of my $1,500, like $20 goes to principal and the rest is all interest. What we're doing is we're taking that money. We want it to work for us for a long period of time. So when you sell it, you're getting more money, yes, over a longer period of time. And so what you can do when you do it right and you make the mortgage right, you start to get these monthly payments, which is why a lot of investors started to invest in real estate. They wanted monthly cash flow. Well, with a mortgage monthly cash flow, keep in mind, I've sold you this house. This is your property. I'm the bank, right? So you're going to make your payment. The payment that most people make sure they make every month is their mortgage payment. And so now, I'm collecting principal and interest payments from you. It's set up very similar to a traditional bank mortgage. You're going to make that payment to me, but I'm not responsible for real estate taxes, especially here in the state of Texas. Our real estate taxes go up a ton each year. If the insurance goes up, it's not my house. That's not my responsibility, right? Your payment to me is set. It's set for a long time. It's very predictable monthly income that comes in, where for everybody who's been a landlord or is currently a landlord, even though the book says the cash flow is this much, it just doesn't work like that month over month. I mean, sometimes it's more. There's no repairs. If your toilet breaks, you're not calling me. I'm your bank. You wouldn't call Wells Fargo and say, hey, come on out here. We've got a clogged toilet. So long-term monthly cash flow is, if that is your goal, then long-term mortgage notes is a really great way to accomplish that. If you have different goals, I've always said this, find your goal and then you can back into it what type of real estate investing you ought to do. But if it's long-term monthly cash flow, you should really consider looking at mortgage notes.
I love it. Hey, bro. So, okay, the strategy that we just went over, does that only work if you buy the property for cash, or can you buy it with like a hard money loan, or can you buy it with private financing as well, too?
Right. And so when I say cash, we do buy some with cash, but we use a lot of private money. A lot of private money. Now you have to keep in mind whether you buy it with hard money, private money. Most of those people who fund your initial purchase and rehab, they're going to want to be cashed out when you sell it. They're not looking to have their note wrapped. That's not what we do. There is a strategy to wrapping mortgages and ways you can do it successfully, but we want to create the best note that we can. We want a first position lien that we've created ourselves, and we do that not only because we want something that once we set it up, we don't worry about it, just payment after payment, but also if you want to sell those or you have someone who wants to buy them, the better note, just like in any business, the better product you create, the higher value you're going to get for that product, right? So we will borrow private money a lot of the time, but when we sell it, we're going to cash that person out. So you do have to have some cash. Now, if you're doing that, again, keep in mind, you don't have to have enough cash for every project, right? People are going to start slowly. They're not going to do as many, but you borrowed the private money, you fixed or you rehabbed it. You've got a seller at the time when you sell it to not create a wrap and create that first position lien. Then you're going to cash out your private money guy. But once you do that, if you sell it or you recoup, you can reuse your same capital to do that. But our business is probably not for somebody in their first day, but you're going to need some capital to cash folks out.
Okay. So let's walk through a deal. Like, let's say I had very little money and I was using private money. And let's say that the note, I was going to sell it right after to get my money back. So can you walk me through a deal like that?
So where people will do that, like, I think a lot of people don't understand, like, private money is just me and you talked about it. You agreed to lend it to me, and whatever we agree as terms or how we're going to work it is what it's not kind of boxed in by a traditional mortgage. So if I had very little money and I was going to do that, I would establish very strong relationships with a private lender or my private lenders, and I would tell them exactly what I'm going to do, because the last thing you want to do is mislead or lie to them. You will never do business with them again. But you tell them, hey, I'm going to sell this, I'm going to sell it, but when I do, I'm going to sell it on a wrap. That will be a junior lien to your lien, and I will sell that. And when I sell that mortgage, then, you will be cashed out at the same time that I am. And just make sure that everybody understands and they're okay with it. There are absolutely lenders that will do that if you built a relationship and you built a trust with them. That's just not our model. When people are starting, and even when I started, I wasn't selling them, right? So I would borrow the money, private money, do the process, rehab. I would sell it on or finance, but I told the private guy, hey, you get longer term private money, 3, 5, 7 years. And I would say, hey, I'm going to sell this on a wrap. I'm going to owner finance it to somebody. They'll pay me and I'm going to pay you, but I need some time to pay you all of your money back. And they'd say, yeah, okay, I understand. Yes, you can do it. And I would continue to make the payments, but I would also pay down their principal, because theirs is going to be, and actually it's going to be a balloon a lot sooner than my mortgage. So I had to make sure that I could pay that off ahead of time.
So basically, when you started off, you actually started off with wraps, and then you transitioned to actually selling the paper in the very end.
I did, because, like most people will, or like most people when I started, we didn't have enough money. We couldn't just cash people out. But it will come down. People say, "Oh, well, no one's going to lend you private money for 3 years."
That's not true. That's not true.
Not true. It's absolutely
not true at all.
You made that up, or somebody else made that up and told you.
Yeah.
It's also not true when people are like, "Oh, well, they're not going to let you wrap it and sell it on finance." It's not true. It's about the trust and the relationship you have with that private lender. If you've done 10, 12, however many deals with them, and they believe in you, and they know that you are going to protect their money, then they're much more flexible on how the deal's set up. And so for me to get longer term private money, 3 to 5 years, wasn't that hard. I wasn't obviously doing as many projects at the time, but then I told them I would sell it on a wrap. They knew exactly what I was doing. There was nothing hidden at all. And they were like, yes, perfectly fine. Just make sure you pay me back by this date. And the way I did it, was I had the notes going. I had a spread, right? Obviously, my cash coming in was more than what was going out. And then I would take any property that I could flip, I get wholesale, any extra money that I could make, and I used it to hurry up and pay down my private lender. The reason I wanted to do that is, one, I want to make sure I could pay them off. But two, if you sold on a 30-year mortgage and you pay it off in 5, you have 25 years of payments that's already set up, and those payments are just going to come, right? And you don't have to do much for them. And I want to see how many times I could do that. And, and like any business, we evolved into doing some different things.
Yeah, amazing. So I'm glad that we brought that up, because I think we can talk about the wrap first, and then we can transition to the strategy that you guys do now as well too, how to position that. So just so for our viewers to understand, if I'm understanding this correctly, you'd buy a property, you would get private money. Let's say that you get the private money for 3, 5, or 7 years, however long you get it for. Then when you're selling the property, you're doing owner financing, but they're basically making the payments to you, and then you're using those payments to pay off your current existing note. In that situation, who keeps the title? Is it the new buyer? Like, are you doing it like a contract for deed, or are you holding title?
So we don't do any contract for deed. I don't know about every state, but it's definitely frowned upon in the state of Texas.
Okay.
There may be some people that'll tell you different things. From my understand from every attorney that I've spoken with, it's not. So when we sell one, we really do. Let's set everybody up for success. And contract for deed is not, in my opinion, necessarily doing that most of the time. So
for the buyer, not for the buyer at all, basically.
Not for the buyer. It's not for the buyer.
It's not benefiting the buyer
at all.
There's a lot of risk.
Yes. And that's why, I mean, it's not a good business model to start, but when we sell it, they get a deed. They own the house, right? So I bought it with my private money lender. I'm the owner. When I sold it with owner financing. No tricks. No, we don't do the rent to own. We don't do any of that. And I'm not beating up the strategies. It's just, that's not what we're doing. They have a deed. They are the full owner of the property. All they have to do is make their payment, and they'll own it for as long as they want to.
Got it. And then how does that arbitrage work? Because obviously there's an arbitrage there. You're paying a certain percentage on the private money. You're collecting a certain percentage. You also said that you're basically offering like potentially 30-year financing, but your financing is a lot shorter. So how does that end up working out in that situation?
So, because it's a really great question, right? So our financing is a lot shorter, but our financing is probably interest only. So since our financing is interest only, our payment or monthly payment is much smaller, right? And then they have a little bit higher interest than what we pay for our private money. But also the difference is, so back up and imagine you're flipping this house, right? Say I bought it for 100, I need to put 50 in it. So you've got $150,000 in there that you borrowed. But when I sold it for a profit, right? I sold it for 190. So their interest rate is off of 190, not exactly right, but 190, and I'm paying interest only on 150. And so then there's a cash flow difference in order to pay that now. And when I started here in San Antonio, we were selling them for like 89.9 and things like that. We can't sell those anymore. I was borrowing like 40,000
at that time. Are you able to pay off the mortgage in that period of time, like the 5 to 7 years with that model? Or
there's a couple ways you can do it. I could do it because the only way that I could do it was bringing additional income to it, right? Wholesaling, flipping houses.
Yeah.
Or, I had a job at the time, and I would save money and I would put it out there. The other way you can do it, and we have done this, and this is a strategy that you have to be able to get bank financing, because people understand that you can take your rental property to the bank and we can refinance it. Well, when you establish bank relationships, typically in my experience, these are with smaller, more local banks, right? You can take your mortgage and refinance it. It's a note receivable, and banks that understand those and understand how owner finance works, they will take that as collateral, and then they will give you a mortgage back out. So we take that same scenario, right? Let's say,
instead of private money actually having bank financing on it, basically.
Right. And so what you're going to do is you're going to make that mortgage, and you're going to take that mortgage over there and say, hey, I have this note receivable for this much money. I'd like to basically use it as a collateral loan, which you're going to refinance it. And then lots of times you can get probably 10-year terms on something like that. Some places 15. And then because there's a difference between your interest rate and the amount that you're going to borrow versus the amount that you're being paid on, then you can make those pay off.
Got it. Now, in this scenario, are you able to sell the houses on a premium because you're offering the paper? And then who is the end buyer typically for something like this? Is it somebody that doesn't qualify for traditional financing, or who ends up buying these properties?
So the first question, can you sell it at a premium? Probably. Do we do that? We do not. Couple of reasons. When you sell something at market value, one, I think you've done the right thing. But two, let's say I come to you with a mortgage note, right? And hey, it's a $200,000 mortgage note. You're going to say, what's the value of the collateral? If I tell you the value of the collateral is 180, you're going to go, wait a minute, that's not good, right? And so we want the mortgage note that I'm then going to sell to you to be lower than the value of the collateral, right? And so it's very difficult people are not going to buy that note from you if there's not some sort of loan to value in there. And then also, even if you pick the best buyers, best borrowers on the planet, you screen them, you do everything that you can, things happen, right? Things happen to people, things happen to everybody, good, bad, owner finance people, traditional mortgage. And so if somebody loses a job, if they have some equity in that property, they can sell that, cash everybody out. They don't have to go through foreclosure. You as the lender don't have to go through foreclosure. It gives a lot more options for them to come out. And the more affordable we keep the payment by keeping the price lower, plus if something was to go wrong, the more options we have for them to get out, for us as the lender, our note buyer, to get out without much headache, the better. So I don't believe in selling them above, the price. And I would recommend that people really think about it before they go that direction. Our typical buyer, we have a lot of self-employed, a lot of contractors. We have many first generation to Americans. They don't have established credit. We don't do terrible credit. Hey, you've been foreclosed on 3 times, got 7 car repos, and you're hoping for the best. That's not, we're not a right fit for them. There are a lot of people who don't have, there's a difference between bad credit and no credit. It's a huge difference, right? And so a lot of these people will get paid. They're contractors. They don't claim all of their income, but they make a lot of income. They've saved for a substantial down payment. They don't fit in the traditional Wells Fargo, Bank of America banking model. But if I was giving tips and things that we definitely look for, we're looking for folks who have saved a substantial down payment. Obviously it depends on where you're listing and your price point of your house, but our typical property that we're going to sell is right around that 189.9. And, we wanted to bring 10,000 down plus all their closing costs, plus their prepaid escrows, which ends up being 25, 30, 35,000. It's not easy for people to save that much money. They have to work hard for it. So if you see someone that's done that, yes, they may not have the same traditional credit, but a lot of them that we sell to, they don't have any established credit. They don't have a credit card. They paid cash for the truck. There's no truck payment, right? So their DTI is really low because they don't have any other fixed debt except for the mortgage that we're going to create for them. Those people, in my opinion, have completely earned the right to buy a house, whether they go to a bank or not. And they are very successful. And they get the opportunity to own a home where they wouldn't typically get the odd opportunity. And it's very successful for us as the investor as well. So
I love it. Are most of these properties like being advertised on the MLS, or are they like advertised like on Facebook groups and hey, look, owner financing available, blah, blah, blah.
Yep. So we do put some in the MLS, but most of ours we do a lot Facebook Marketplace and different spots in there. A lot we will sell from a sign in the yard, owner financing available. It's here or in the neighborhood, because a lot of ours are, hey, we saw the sign down the street. I live in this neighborhood. I'd like my sister to live in this neighborhood as well. Said you'd finance her the house. Or, hey, I want my grandson to own a house, my cousin, somebody that they know, by word of mouth, they're telling people because really they want them to live by them. And we get a ton of leads for buyers, as simple as that. And we just let them know, hey, this is our system. This is what we require. And not everybody's ready to buy a house traditionally or with owner financing, but there's a lot of really, really good people out there who just don't fit the bank model. And then the other part is people just don't want to go through the bank. I contracted a house. The guy's got an 800 credit score. I asked him why he didn't get bank financing. I just don't want to mess with that bank. I don't want to go through it. I'll just buy it through you. Okay.
Well, I'll tell you even this, like, it's funny because we started building accessory dwelling units and we started looking for financing for these accessory dwelling units. We had first loans at 3%, so we didn't want to refinance. I was introduced to private lenders. And then once I started like finding the private lenders, I'm like, oh man, like this is so much easier than going to a bank. So like recently, like I called a friend that I have. I'm like, hey, look, there's this opportunity that we have, 250,000. This is how much your interest rate would be. He's like, great, I'll do it all day. And after that, I'm just like, man, this is like, and I've gotten asked this question. I'm like, look, I qualify. I have 800 and some FICO score. I just don't want to go through that process. Like it is a lot easier to basically do it that way.
It's a lot easier. And we run into it all the time. I mean, I'm telling you, we see those. Now, we see a lot of credit scores that are NA as well, and there's other reasons. But you want to look for somebody who has income so they can cover it. You want to set them up for success. It's really a better idea that doesn't have, previous things that any lender would not want to lend to them on. But good, hardworking folks in a blue collar neighborhood that just want to own their own home and are more than happy to pay the bill. We have a lot of success for us and for them. And it's just, it's been a really good business model for both sides.
Yeah. Now, in this case, it's basically exactly what we talked about. You're building a residual stream of income by arbitraging what you're paying for the money and basically what you're lending the money at without having to deal with the tenants or the toilets or anything like that. You're not responsible for anything. So you're able to build a stream of income that way. Let me ask you this. In a situation like the one that we just described, which is like a wraparound mortgage, are you able to sell the mortgage as well too? Or is the only exit paying it off?
You can sell them. Typically, in my experience, somebody that's going to buy that may not give the same value for a wrap as they will a first position lien. They are going to want to also not keep the wrap. Typically, they're not going to want to keep the wrap, right? They're going to want to buy the mortgage from you, and they're going to want to cash out
the private lender, basically.
I've seen people where they try to do things, and they're like, "Hey, well, I've set this all up. Buy it. You can keep this. You pay under here, and you don't that." I do not recommend it. I don't think there's a whole lot of transparency in people that do it that way, and I think over time you end up with issues, and everybody wants to point the finger in a different direction. So yes, you can sell it. Don't think you're going to get quite as high a value, and they're probably just going to cash out your underlying loan, or your underlying loan is going to want to be cashed out at the time you sell it.
So let's go over the current strategy that you're implementing. So in the current strategy, it's a little bit more capital intensive, meaning where you're buying the properties in cash or private money.
Yep.
You're basically selling them on owner financing. What does the process look like whenever you sell a note in that vein? So I've never actually done that. So this is like completely like new. So if you could explain that, that'd be amazing.
Absolutely. And it's going to blow your mind because it is remarkably easy to sell it. When so we have an attorney, he writes it up. And the way I explain it to most people, the process, if you've ever had a mortgage, you're paying your mortgage, right? And then all of a sudden you're 3 years in, you get a letter, hey, you're doing great, nothing changes, but you don't pay us any more. Now you pay SunTrust Bank
I've seen that, yeah.
Well, they just sold that mortgage to that other bank, and the bank's like, hey, now you pay us. So what we're going to do is that same thing. Where it's going to fit is if you're there and you're like, hey man, I'm doing great. I get it. I like the idea of owning mortgages. I'm not going to do any of that work. I don't want to do what you do. I want to be as passive. So you say, okay, Nick, I want to buy a mortgage for you for a certain amount. I'm going to say, hey, I have this mortgage. Here's the terms. I will describe it to you. You probably ask me some questions like, hey, great, show me that. Show me the collateral. Show me that you set up the mortgage the right way. You went through the right process, RMLO, where's the servicing, et cetera. And then we're going to get a transfer of note and lien written up by the attorney. So basically, I'm going to sign this paper that says I transferred all my rights to this mortgage, right? My rights to the lien, my rights to collect the payments over to you. I'm going to sign a piece of paper called an allonge, which basically says, hey, I don't have the rights to collect payments anymore, but I sign them over to you. You have the rights to collect the payments. We'll record the transfer of lien at the county courthouse, right? Just in the public records where, so if anybody like later, somebody sold it or some title company was looking, they would be looking to who is the lien holder so that they could then come find you. We will typically have all of ours already set up with servicing. For folks that don't know, servicing is going to collect that monthly payment, right? So they're going to collect the payment from the borrower, principal, interest, taxes, and insurance. And then they would send me my principal and interest to whoever's the note holder, and they will escrow for tax and insurance. So we set up all of ours with servicing. So then we'd contact the servicer. Hey, we've sold this note to you. Don't pay us anymore. Now you make the next payment to them. Hey, great, no problem. It's about 4 pieces of paper and a transfer. It's really, really not hard.
And then at that point, you would just provide the servicer with a transfer of note and lien document at that point. So I think the key, if I'm understanding correctly, the key is in creating mortgages that people want to buy. Mm-hmm. Right? So 100%. So what would a good mortgage look like, and what would a bad, like something that like things that because I've always thought about this. So I have that apartment complex that I talked to you about where the owner financed 4.3 million. I've always thought like, what if he ever wanted to sell that? Like, could he sell it at a premium or would it sell at a discount? And I guess that's the part where I don't understand.
We'll stay big picture on this one because we could go down some crazy rabbit holes. But for most people, when you sell a mortgage, there are big groups, and this can go, there's $50 million packages of mortgages that get put together. I'm not even in that ballpark. Sometimes those are sold at a premium, but they're sold up to someone who needs a lower return and they want to buy in bulk and they have a lot of money. Those are like big institutions. If that person's trying to sell a mortgage of, 4.2 million, it's a little harder to sell because there's not as many people that can buy a $4.2 million mortgage. The better your product, and the better you can produce for your investor, because that is your investor who's buying at the end, the higher value you'll get for it. We do sell ours at par value. If they owe $162,417.16, that is what we sell it for, right? We make the best mortgage that we can. We say, hey, this is what this mortgage will do. And we do everything we can to set it up for success. And so we get a high value. People telling you that you have to discount a mortgage by a large amount, they either are not selling to the right person or they haven't provided enough value in that mortgage. Which ones are going to get lower value? If you took lower down payments, so we do require a substantial down payment. That means
what's substantial?
So we're going to have 10% down or more most of the time, which for our buyers, they're committing, their total cash in is $25,000, $30,000. I could make them a mortgage with, $5,000 down. And it doesn't mean that all of them would suddenly be unsuccessful. It just gives us a lot better chance of having a long-term successful mortgage by getting a larger down payment. It does show that, they've worked hard, they saved up more money, and they're more financially committed. You want a high enough interest rate, right? So if I created my mortgages at 6%, that would not be near as interesting to you. Our typical mortgage rate, since it'll be the next question I'll tell you, typically 10.9%. So if I can get you a set 10.9%, for the next however many years with real estate as collateral, that's really good for a lot of people. And they're like, man, I really like that. I like that I get to keep the real estate as collateral until I'm paid off. And that's a really good return, and it's set. It's not like with the market where you're going to go up, you're going to go down. It's much more predictable. So you have to have a certain interest rate. You need to set up the right way. I see people create them. We always use an RMLO, which is a residential mortgage loan originator. big picture on what that is. So there's one in every bank that's making a mortgage. You just don't really know if you got a mortgage, they used one. You're not seeing them for most people. What they're going to do is they're going to check. They're going to make sure we didn't do anything with predatory lending. They're going to make sure that we qualified everybody on income. They're going to run credit reports for us. They're going to do initial disclosures for us. They'll also help us create final disclosures, make sure that everything fits within the parameters to create a good quality mortgage. We didn't do any predatory lending, and then they're going to put their stamp on it. And so most people that buy a note are going to ask you if you used an RMLO. So you need to do that, not just, oh, well, we just went to my attorney and he did some documents. Well, that's great, but that is not going to have near the value. And then it's really going to come down to your relationships with people. And are you providing the right product to the right investor or note buyer? Not everybody is looking for the same return as other people. Not everybody's looking for the same amount of work as other people. You need to have the right product and then sell it to the right person. Buying notes for me is not right for everybody. I say this at least once a week, and that's perfectly fine. But for a lot of people, it's a really good fit. And so find that person that needs what your note provides, and then they're willing to give you, a fair price for it.
Got it. Now, in that situation, how do you make money?
So we've got our cost built in, and we've got our profit built in. So I bought the house at 100 and I sold it, we rehabbed it. We put in another 40, 50,000, and then I sold it at 190. We'll get some money on the down payment, right? We obviously have some costs. We had to sell it. We had some costs when we went to sell it. So, but there's still a spread in there for us, right?
Yeah.
And so when I sold the mortgage, I'm cashing out and I'm getting that spread that's in there.
When you say, I'm confused.
Okay.
When you say spread, like,
right.
So, meaning like points?
No, not points. So the total amount that we've got invested in the property, if I paid $100,000 to buy it, and I spent $50,000 rehabbing it, I've got $150,000 in it. When I sold it at 190, right? I got a down payment. Say we kept $10,000 of that down payment. So I got that, right? And I made this mortgage. We had some other cost, but just for simple math, let's say my total cost was $150,000, but the mortgage that's there is $175,000. If you gave me $175,000, I have the difference of the $150 that I've got total in and the $175 that you paid me. So there's, $25,000 just to keep it
simple. Got it. In profit. So, but in that case, like, wouldn't it just be the same thing as almost just like somebody paying you the 190 up front and just collecting your money, unless there's like points or unless there's like, you're selling them at a premium, or, what would be the point of going through the whole process of creating the mortgage, selling it, if it's not financially more beneficial?
It relates to our entire business. Okay. So I don't necessarily think that everybody should start a full business doing this, but if you have people that want a certain product, those people that buy those mortgages are also going to be your private lenders. They're going to fund a lot of those parts of your business. So you want to create things for them. If I could keep every single mortgage, I would. If I could keep every mortgage, that was my initial plan starting. But when you do more, it's very capital intensive. It's just not realistic to keep every single one. And then you make something that other people want. And so, yes, the profit on those is similar to if we flipped the house and we sold it. I think you're very accurate in that. But what happens is, as you create more money from other people, they're going to refer more people to you, which is going to help your business. And it really helps our whole cycle and our whole ecosystem of everybody that we work with. But no, on those, we don't have to make a ton. But also, the more that we sell and create for other people, the more capital we make, the more we can keep for ourselves. I mean, it really does keep everything moving.
Yeah, because you're basically just turning the money. So the whole business model is to keep as many of them as you can, and then basically whenever you need to free up some liquidity, you basically sell some of them off. Now, let me ask you this: you talked about how sometimes when you're selling them to people that you know. Is there like a marketplace as well too to buy and sell loans as well too? And then do you ever utilize that as well?
There are some places online, and you'll see people list things, but there's a company called PaperStack. I have no affiliation with PaperStack, but you can list your mortgage note for sale, and people go through and look, and they're a middleman that will help facilitate the deal. I have sold notes on there. No, most of the time, no, we don't do that. We know enough people and we have enough demand that as we have them coming up, I know pretty much what that note is going to look like. And we're looking for somebody that fits. And they're saying, hey, I'm looking for something right in this 165 range. A 30-year 10.9 would be great. And when we have one, I'm like, hey, this one's coming. Do you want it? And they'll just say yes.
Yeah. Under what, and is there any circumstance where you would sell the note at a premium or no?
No, I mean, I guess I probably could, but it's also, if you think about the whole business, I'm much better off to give you
A great deal,
a
basically.
great deal, because nobody buys one note from us. If it is, it's because it's their first. People buy one. You don't need to just squeeze every dime out of them that you possibly could. Give them a good deal. Get them the cash flow that they want. They will come back and buy another note.
Got it. So it probably just makes it easier for you to sell your listings as well, too, even in a marketplace like right now.
Oh, absolutely.
And that's probably a benefit as well, too, that maybe in some case, yeah, you're selling it at market value, but it probably makes it easier for you to move it because you're able to expand the pool of buyers. Now, let me ask you this. If somebody wanted just to pay you off, would you ever consider that as well, too, or no?
Sure, unless I've already told somebody that I made this note for them, right? Because then I wouldn't go back on it. But yeah, I mean, sometimes we have people show up and we think it's an owner finance. They're like, no, we'll pay cash. Oh, well, sure, right? No problem. I'm not. I mean, if somebody shows up and they've got traditional financing and they've got a 6% rate and they love this house, yeah, we'll sell it to them. You know, I can make a note out of the next house. I'm not so firm on that we wouldn't.
Yeah. And then an RLMO is basically just somebody with a real estate license, or is that?
No, they're going to be licensed to be a residential mortgage loan originator. And so a couple things like they're going to do, right? They're a third party. They are licensed. You want them to look over your file and say, hey, everything was done well and on the up and up. Did we document? Because we still have to document and prove income. We're not just like, oh, you just tell me you make enough. Cool. No problem. Sign here. No, we've got to document it. There's lots of ways you can do it, right? But paycheck stubs, bank statements, we're putting together a full file to show that they have the ability to repay. We're also going to check them for debts and liens, right? Because it's not just how much do you make, it's how much do you spend each month, right? And they're going to help us document that, put it in a nice little neat folder. They're going to make sure that our loan terms are within compliance. You know, we're not selling them at 22% interest or something crazy like that. And then they're also going to help us with our disclosures. So now we have a third party that created the disclosures, sent them. They have to be signed a certain amount of time before closing. And then they're going to send, hey, here's your final disclosures. These must be also like, you know, just like a traditional mortgage, you know, hey, you have to sign your disclosures before we go to closing so that they know what they're getting into and that we've disclosed everything. No hidden fees, no tricks.
What is the MLO you typically charge for doing something like this?
They're about $1,000. I think they're $1,025 now.
Got it, which is nothing. And then who comes up with the underwriting guidelines? Like, meaning, like, obviously it's going to be a lot easier than going through a bank, but it sounds like you're still documenting things. How is the underwriting? What is the underwriting? Who comes up with the underwriting guidelines? Like, meaning, like on a traditional loan, you may only be able to go to a certain debt to income ratio. In a situation like this, are you able to go to a higher debt to income ratio? Also, like in a traditional loan, in some cases, they want to see like, oh, where the money came from. Like, are there rules like that? Like, oh, the money can be a gift or the money can't be a gift or the money has to be seasoned in the bank for a certain amount of time. Or if somebody has proof of deposits, like what is that? Like who comes up with those guidelines and how is that different than a traditional bank?
Sure. So, I mean, we're allowed to set a lot of it ourselves. But as far as taking somebody with, a super high DTI, 70%, some things we're not going to do it.
Got it.
Just not interested. That's not who we work with. Could we get away with doing a higher one? Yes, we probably could if we wanted, but one, we don't want to, two, we don't need to. Because if you were going to buy this mortgage from me, you want to know that I had your best interest, right? So We want to set everybody up for success. It's a much better long-term plan. So we don't stretch the DTIs. Most of ours are well under where they're allowed to be. As far as their income, there are different ways that you can document income. Where a traditional bank may have certain rules, you have to have X, Y, and Z, and this is our box, and we do not go outside of that box. That's what it is. But we can use affidavits, we can use deposits, and most of them people will share. It's very clear that every week this guy gets $2,000 from this same guy, and that guy can sign an affidavit stating, "Hey, I do pay this guy. He's a roofer, and I pay him $2,000 a week." And you can see it right there in the statements. They're not lying. It's just not documented the same way that a traditional bank may want to see it. And so once we'll take all that and we'll send it over to the RMLO, and they'll say, yes, this actually works, this is good, or no, this is fine, but we also need this.
Got it, which is amazing.
So
It's just you're still documenting it. It's just like a little bit different in some cases, basically. And it sounds like there's a little bit more flexibility. Now, if I'm buying the note, what do I get to see? Do I get to see like a file like for the purchaser? Like if I say, hey, like show me the file that you guys had, or is it just like, hey, look, this has already been approved by the RMLO? Like basically, like what does that look like?
So there's certain things we can share, certain things we can't, right? But if you were asking me what are the first things you're going to want to look at, you're going to want to, hey, can you send me the note? Send me the deed of trust, right? The promissory note, for anybody who's not as familiar, the promissory note, big picture, is going to say, hey, this is how we agreed we're going to get repaid. So many months, principal and interest. The deed of trust is what's going to tie that to the collateral. Hey, if you don't do what you said you were going to do, then this house is the collateral. You could lose the house as a collateral. You would ask me for that. You would ask me for the warranty deed with vendor's lien that we created. You could ask me for the disclosure. So the closing disclosure says, hey, these were what they paid. This was the sales price of the house, and I would send you that. You can ask me for any application, credit reports, things like that we've done. And so some people will ask for those, some won't. I mean, typically when someone has bought multiple notes for us, they tend to ask for assets. But yeah, it's a relationship business. Like, I mean, so's yours and so's most of them, right? But you can ask for all of those things. You can ask to see anything from the servicer that they can show. So let's say I've had the mortgage for a long time and you really wanted it. You could say, hey, can you send me the pay history, right? And you can see the pay history that's in there. Most of the time people, just from experience, ask, okay, you used an RMLO. Great, no problem. Show me that. Okay, well, what's the balance? No problem. What's the collateral? All right. What's the term? What's the rate? Right. And then they may ask some, a few other things in there that we can share, and we'll give them, we can. And if they feel comfortable with it, they'll move forward.
Is part of the file an appraisal on the property, or and does the buyer, whoever's purchasing the note, ever request an appraisal done at the time of purchase, or no?
Sometimes they will. Typically, if they are, they're going to ask for a BPO. Which, if somebody wants one, yeah, we'll get you a BPO, broker's price opinion, right? So they're going to want somebody that's not us, right? A licensed broker to say, hey, this is what the value of the collateral is, and that's what it would be. We don't typically have full done appraisals, but there are some people. A lot of our folks are local, and they will feel comfortable with the numbers. But if you want a BPO, it's not a problem.
Now, let me ask you this. Are season notes better than non-season notes? Meaning, like, do most investors require, if I'm purchasing a note from you guys, is it common practice where I'll say, hey, look, like, I only want to buy notes that they've made payments for a year, and then I'll buy it at that point? Or I guess at what point are you guys selling the notes? Are you guys selling them within 3 months of originating them, within a year, within 3 years, 5 years? And is there any difference?
I mean, so it's an excellent question, and I think everybody should do what fits for them. We sell a lot of ours within the week of making them. Okay. It's seasoning it that or showing that they made 2 payments really doesn't make that much difference. Now, if you're selling them on an open market and you're going to go into some online forum and post your note on there, yes, if there's no relationship there. If you've got 3 years and you can show pay history for that, then you're probably going to get a higher value for it. We don't have them that long when we sell them. So it's not something that fits in our business. And I'm definitely not saying that that's wrong. but we typically have a note coming up. Here's what it is. I like the notes earlier because you get all of the interest right out of the gate. Depending on what fits for you, as a note buyer, I mean, really, you can ask for anything. It's just what, it has to be an agreement to the person that has it. What are they going to sell and what do you want to buy? For us, we feel like we create a good enough product and we stand behind it that typically we have somebody that wants to buy it right after we make it. So we just don't run into the seasoning issue a lot. That's just not our business model.
Now, let me ask you this. I took some training earlier on in my career and they talked about not what you're talking about. They just talked about investing in notes in general and going to different marketplaces and buying notes. Second mortgages,
yep.
Do those sell at par, below par, premium, or they just don't sell at all?
No, everything's for sale, right? But you're not going to sell them. We don't make them, but you're not going to sell them at par, right? Because so you have this first position, so you got your superior loan, and then you've got your second. All right. If depending on how it's written, there are some variables, but big picture, if this second wants to foreclose, say the second doesn't get paid, I want to foreclose. Well, that first is still there, right? You foreclose, you still have to pay the first. Mm-hmm. Well, if this first here and hey, I'm not getting paid, and they foreclose, there's nothing that says they have to pay you, right, for your second. So your second can fall off. It's in an inferior position. So there is always going to be more risk there.
The first can only foreclose if that payment's not being made or that loan comes due.
Absolutely.
Yeah, that's the only time. That's the only time they can foreclose, basically. Mm-hmm. Got it.
They can't just do it out of nowhere. But when you have the second, there's a way to, there's lots of ways you can do it. There's ways to create, if you own the second, that if you made them both originally, you can make it where, hey, if they don't pay, I have right to cure the first. I have right to pay off the guy that's in the first. But most of the time when people made those, they're not necessarily that way. And if you bought just the second, you want to make sure that it's performing and good and you feel really comfortable. Because if that first did foreclose, it may not. It's a lot higher risk if the first forecloses on it, basically. So let me ask you this: if you were buying a second mortgage, how would you make sure that is structured in a way where even in second position, you're protected as much as possible? Obviously, loan to value ratio would be important as well, too, right? Meaning if it's cumulative, let's say the first is 300, the second is 200, and the property is worth $1 million. That's 500,000 in cumulative loans. Property is worth $1 million. You're at a 50% cumulative loan to value. How would you structure a second loan if you wanted to increase the chances of, or if you were buying a second loan, how would you need it to be structured? Well, I always want my money to be safe, and then I want to return, right? And so I would like it to be structured. Now you have to have enough capital to do this, but I'd like it to be written. Hopefully, they were made at the same time, because lots of times people will make the first and the second right at the same time, and I want that second to say, hey, if the first isn't paid and they're going to foreclose, that I have the right to pay that off first before they foreclose. They have to let me know. And hey, I'm going to give you your 300 grand because I want to protect my 200, right? Also, when you have that much lower loan to value, there's a much greater chance that it's not going to actually go to foreclosure and that they would just sell it, or somebody's just going to get it paid off, or, it's $1 million property. You could sell it pretty quick for 650, and then everybody's going to get paid. So that loan to value is really going to help protect you. And I'd want to have less money invested, and I'd want to make sure that I'm getting paid back sooner. So let's say I did buy that 200, but I only paid 150 for it. But I want my payments to be coming in, because once I put out my 150, how many payments am I going to get back? As I'm getting back the payments, my risk goes down because I have less money in that property, right? Each month I get paid. I have less of my 150 still in that property. And so that is what I'd look for. But, I'm not super interested in doing a lot of seconds. It's not the business I want to create. Not that you can't make money at it, and not that people are not successful at it. But you're going to work a little harder, and you want to be a little more careful going into that market. Yeah.
I love the idea of having that right to pay off. I didn't even know that that was possible on a second, where you can structure it where they have to notify you basically before they foreclose.
Yeah, and so that, I mean, we don't do it, but I know a guy. He's very successful at it. Right, he sells owner finance similar to us. When he sells it, he'll do like a 75% first mortgage and a 25% second. He keeps the second and he sells the first, but it's written in there that if there's a problem, hey, he can make that person whole, so he doesn't lose his
25% in second
25%.
position, basically. And that's a lot higher risk right there, because essentially what he's doing is he's doing 100% owner financing. And that means that people are coming in with a lot less skin in the game. And if there's less skin in the game, the probabilities of a foreclosure are a little higher in some cases, basically.
Typically, you want to stack the odds in your favor, right?
Yeah.
And so, yes, I do believe it's much riskier.
Why do people, not why, on a platform like PaperStack, what kind of notes can people buy?
Man, there's all kinds of stuff on there: land, mobiles, commercial, any kind of mortgage that people have done. I mean, the guy that, did your loan there, he could just throw it up there, because you can just slap it on there and say, hey, here's the terms of my note. Here's what I want for it. And it's a way that people could to communicate, and they can do a deal. And there's a fee that they take if you do a deal through them. The last time I looked at it, there's several single families, there's commercial deals on, there's a lot of land deals on there, where people have owner financed land that, that has it's not really what we do, but it has its own pros and cons with it. And so I see a lot of deals like that. And, for people that's a good fit for them, then there's at least a place they can go look.
Are there certain asset classes that no matter what sell at a discount? Meaning, like, if you're financing land, is that different than financing a cash flowing rental or a single family residence?
I don't think you can say always sell at a discount. If you sell something at a 7% interest rate, you're going to have to discount it. Nobody wants it, right? It's just not. But if you sell it at something and you have a good product at a higher rate that people are happy with, there's a lower chance you're going to have to discount that. It doesn't matter what class it's in. You see some land notes come up at 14% and things like that.
And some people may be interested in something like that because it's a higher premium. What's like the minimum interest rate that you wouldn't really take a discount on? Meaning, like, hey, like, is the market right now like around 10%, that if you sell it, that if you create a note at 10%, you'll likely be able to sell at par?
For people thinking that they're going to start, so I want to make sure that we lead people in the right way. People thinking that they're just going to run out and make notes and sell them at par is less likely. You can absolutely do it. I'm doing it, and I'm not better or smarter than anybody. But it has taken a long time to get here, and we had to make sure that we were making the right product and selling them to the right people and build the right relationships. So there's not just an interest rate where you could say, hey, if you have this rate, you can, but also you got to know, I mean, if you sold something at 6-7%, it's just not as exciting to people as something that's at 10%. So you just got a better chance if the investor gets a little higher return.
Got it. I love it. And then the last thing I wanted to ask you was, are any of your investors doing anything with you guys on self-directed IRAs, or most of these? Yeah.
All the time. The guys crush it, because what happens in the self-directed, it's most folks are going to know when that money comes back in, it's coming back in, tax-free, tax-deferred, however you have it set up with this IRA, 401k. And so a lot of folks will buy them in there. And a lot of those people, you got to think about where they're at, right? They're getting closer to retirement. They have some money in here. They want to be invested in real estate. They love the idea of the note, but they don't want to be a landlord, right? Most of us didn't wake up and say, I can't wait to be a landlord. You didn't. You said you were going to be a real estate investor, or you wanted cash flow, and so you became a landlord. It wasn't like landlord is going to be fantastic. And so when you show how you can make cash flow through the notes, somebody that's setting up for retirement or just wants monthly income, passive income, man, I buy this note, got a real good idea of what's going to come in each month, and I can plan off that. A handful of notes, maybe it's $4,500 a month, but it's can be much more predictable, and you can really plan on what's coming in. And I've seen a lot of people use it to create just another income. It's like another paycheck that comes in each month, even after they retire, or, even just to supplement while they're still working.
Well, a lot of times I'm seeing it with like older clients, and the older clients are like, man, I've owned the rentals already. I've owned rentals. I've had to deal with tenants. They're like, I don't want to deal with that. I just want to collect the money and not have to worry about anything. Yes, I miss out on the appreciation. Yes, I miss out on the depreciation, meaning the tax benefits. Yes, I'm not getting any principal pay down, but it's just like, I'm okay. I'm getting 10% on my money, and that money comes in like clockwork every single month. And my money's actually backed by something, unlike you do a bond or you even do stocks. You have no idea what the collateral is on a lot of those things, or even a CD, you're protected by the FDIC up to 250 basically. Mm-hmm. But other than that, like, you really don't know what the collateral is. So this is like an opportunity for somebody to have collateral in something that they know, right? Mm-hmm. And then they basically collect the monthly payments. So
that's spot on. And for a lot of those folks, they find it to be a great choice, and they're not wanting the headaches. I'm a landlord. There's headaches. It's just part of it. I'm not saying don't do it. I'm just saying know what it is, right? But monthly passive income with the real estate as collateral could be a really good piece of your portfolio.
So it's funny because I'll get, whenever I've introduced clients to private lending, obviously collateralized by real estate for some of the projects that we do. And a lot of the questions one of the questions that they always ask me is like, what happens if the person doesn't make the mortgage payment? Mm-hmm. And my answer is like, well, you have a mortgage on your house. What happens if you don't make your mortgage payment? And they're like, well, the bank's going to foreclose. I'm like,
that's it.
It's the same exact process, right? Cool. I've enjoyed this interview. I learned a ton. Obviously, like, I'm always looking to educate our clients. So if somebody enjoyed this interview, where can they get in touch with you? And then also, is there any final words as well too?
I love it when people reach out. We can almost all work together. We just have to connect. So if I don't know you, I don't know how we help each other. Please don't hesitate. But you can shoot me an email. We could always set up a time. It's Nick, N-I-C-K and it's all spelled out. It's sellmysanantoniohouse.com. Or if you just guys want to give me a call, shoot me a text, be like, hey, can we set up a time to talk? I'll give you my phone number, 281-615-7007. And my final thoughts would just be really think about what you want to get out of real estate investing, and stay focused on that. Everybody's going to pull you in a different direction. But if it truly is monthly passive cash flow, look into owning notes. What does that help you do? What does it help you avoid? What does it give you and not give you? And just make the best choice for you. And, I just wish you all the success.
Let's give Nick a round of applause, guys.
Thanks, man. Thanks for having me. I appreciate you.
Good. So in today's episode, we had Nick Disney. He talked to us about creating passive income with mortgage notes in 2025. We talked about how to buy the properties. We talked about how to create the mortgages, what makes good mortgages, what makes bad mortgages. We talked about first position loans, second position loans. We talk about holding on to them and selling them. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode would be helpful, make sure to hit that share button. Thanks again, Nick. I appreciate your time, and this was extremely helpful for our viewers.